Good morning. This is Bryan with Cutler Investment Group. In response to the COVID outbreak, the Fed has cut the short-term lending rate down to effectively 0%. This has brought down the yield capabilities for many instruments people are used to, like cash in a bank, treasuries, things like that. So, excuse me, in response to that situation, what we have looked for here are some alternative ideas on how to create yield, recurring income, without taking on undue risk. Here are some thoughts. For a few examples would include the S&P 500. Right now, the stock index, even though it has market volatility for sure, as we've seen, it is yielding 1.8 to 1.9% depending on the day. That's about 3 times the yield from a 10-year treasury. Corporate bond funds. We use some short-term ETFs that are yielding between probably 1.4 and 1.6%. That is more than double the amount from a 10-year treasury. We've also looked at foreign stocks. Foreign stocks have not returned nearly as well as domestic stocks in aggregate in total return, but their yields are very often 2.5%, 3.5%. And we also think they have some market upside potential just given how low their valuations are relative to us. So what we look at here is our balanced income portfolio, our 60 stock, 40 bond type volatility mix is yielding right about 1.7%. It's no great shakes in the bigger picture, but right now that's pretty good, especially in relation to a 10-year treasury that's yielding, depending on the day, 0.6 to 0.7. We think that kind of combination from that variety of sources will give you market exposure, upside and downside, but in the long term, we're looking for upside, along with as much, if not more yield than you could get from some very long government-based positions on the bond side. And we think that's a good trade-off. If you have any questions, please reach out to your advisor. We'd be happy to talk about your specific situation. Thank you very much and stay safe. Bye.